Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Upbound Group Inc. Annual Report. Upbound Group Inc. offers a diverse range of businesses and services that cater to various needs of consumers. The company operates through four main segments: Acima, Rente Center, Bridget, and Mexico. These segments provide financial solutions to customers in the United States, Puerto Rico, and Mexico. The company's product offerings include furniture, such as mattresses, tires, consumer electronics, appliances, tools, handbags, computers, and accessories. It also provides merchandise on an installment sales basis, catering to consumers who may not qualify for traditional financing. This includes lease-to-own transactions through staffed or unstaffed kiosks located in third-party retailers' locations, as well as virtual options. In addition to its retail operations, Upbound Group Inc. offers various financial health products and tools through mobile and web applications. The company operates a range of store formats, including retail installment sales stores under the Get It Now and Home Choice names, lease-to-own and franchising locations under the Rente Center and Rimtime trade names, and e-commerce platforms. Overall, Upbound Group Inc.'s business model is designed to provide accessible financial solutions and products to consumers who may not have access to traditional financing options. Its diverse range of services and products makes it a one-stop shop for customers seeking affordable alternatives to traditional retail and financial services. The recent decline in Upbound Group Inc.'s stock price can be attributed to the company's revised fiscal year 2025 guidance announced on October 30, 2025. Despite reporting solid third-quarter results, the company lowered its adjusted EBITDA and earnings per share (EPS) guidance due to several factors. These include margin compression in the Acima segment caused by softer vintages and product mix shifts, weaker performance in Rente Center resulting from a smaller store base, and integration costs associated with Bridget. The revision of fiscal 2025 guidance led to a significant drop of -14.84% in the stock price on October 30, 2025. This decline was driven by evolving consumer conditions that have impacted the company's performance. The cautious outlook presented by Upbound Group Inc. has likely contributed to investor concerns and resulted in the notable decrease in its stock price over the past year. Upbound Group Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Upbound Group Inc. trades at a lower price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.72 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 79% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 7.57%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. The acquisition of Bridget is a significant driver of revenue growth, with a purchase consideration of $395.4 million and potential earnout payments up to $60 million. Additionally, subscription revenue grew by $2.7 million in 2024, and is expected to decline to $1.4 million in 2025. On the other hand, franchise royalty revenue declined by $1.3 million in 2024, but is expected to increase to $1.4 million in 2025. Installment sales receivables revenue grew significantly, with a growth of $9.7 million in 2023 and 2025. However, interest payments received on installment agreements revenue declined by $1.7 million in 2023 and is expected to decline further to -$9.7 million in 2025. The increase in estimated uncollectible payments and returns is a driver of revenue decline, with $75.136 million in 2025 compared to $19.35 million in 2024. The decrease in accounts written off, net of recoveries, is also a driver of revenue decline, with -$58.765 million in 2025 compared to -$20.314 million in 2024. Segment-level drivers also play a significant role in determining revenue growth or decline. The ASIMA segment experienced a 17% increase in revenue from $1.931 billion to $2.261 billion. In contrast, the Rente Center segment saw a 0.3% decrease in revenue from $1.986 billion to $1.98 billion. The Mexico segment experienced a 5.7% increase in revenue from $74.625 million to $78.726 million. Overall, these factors contribute to the complex dynamics of revenue growth or decline and highlight the importance of considering multiple drivers when analyzing financial performance. Net income experienced a significant fluctuation between 2023 and 2025. Initially, it decreased in 2024 compared to 2023. However, it increased by $50.2 million in 2025, marking a turnaround. The most substantial increase of approximately $395.4 million was attributed to the acquisition of Bridget. Profit margins also underwent changes during this period. In ASIMA segment, gross profit margin decreased from 31.1% to 30.4%, while operating margin increased from 11.3% to 11.7%. Conversely, in Rente Center segment, operating margin decreased from 15% to 13.2%. The reasons behind these changes are multifaceted. Disruptions in information management systems and higher costs of merchandise and merchandise losses affected the ASIMA segment. Increased operational costs, decreased net sales, product recalls, quality control issues, loss of access to external data sources, and inventory management challenges also contributed to the decline. Furthermore, uncertainty in consumer spending, rising costs of purchasing merchandise, labor, and other expenses, as well as limited control over inflationary forces, posed significant challenges. The increasing competition from e-commerce channels and a substantial amount of indebtedness incurred by the company further exacerbated these issues. The company's financial performance is a key indicator of its overall health and sustainability. One crucial aspect to examine is the generation of positive operating cash flow. According to the provided summary, the company has consistently demonstrated this ability. In 2025, the company generated $305.6 million in positive operating cash flow, as stated on pages 49 and 50. This figure remains consistent across multiple sources, indicating a reliable and stable financial performance. Furthermore, the data from page 67 shows that the company achieved a similar level of success in 2023, with $200,290 in positive operating cash flow. The most significant indicator of the company's ability to generate positive operating cash flow is the substantial figure reported on page 98, $1,141,111,000. This impressive number demonstrates the company's capacity to produce a large and consistent amount of cash from its operations. Overall, these figures suggest that the company is indeed generating positive operating cash flow, indicating a strong financial foundation for future growth and success. The company's debt level and interest expenses have undergone significant changes. According to the extracted summaries, the total senior debt has increased from $867.7 million in 2024 to $1,126 million in 2025, indicating a substantial rise in debt levels. This increase is attributed to borrowings under the ABL credit facility. Furthermore, interest expenses have also seen an upward trend. The interest expense for 2025 was $112,980,000, compared to $110,585,000 in 2024, representing a slight increase of 2.7%. However, it's worth noting that there are instances where interest expenses decreased by -2.1% from 2024 to 2025. Overall, the data suggests that both debt levels and interest expenses have changed significantly, with the former increasing substantially and the latter experiencing fluctuations due to variable rate indebtedness and potential impairment of goodwill/intangible assets. The performance of various segments and regions within the company has been mixed, with some areas excelling while others struggled. Segments that performed well include Acima, which saw an 8.6% growth in gross merchandise value, GMV, and a significant increase in operating profit. The Brigit segment also experienced impressive growth, with revenue and operating profit increasing by 100%. Mexico was another strong performer, although its growth rates were more modest. On the other hand, the Rente Center segment struggled, with revenues decreasing by 2.2% and operating profit declining by 16%. The company's lease-to-own stores also experienced merchandise losses as a percentage of revenue, indicating potential issues with inventory management or pricing strategies. The management of the company is optimistic about its outlook and strategy. The key areas of focus include expanding its e-commerce solutions, undergoing a digital transformation, and growing through strategic acquisitions, such as the acquisition of Brigit and Acima Holdings. These initiatives are expected to drive growth and expansion for the company. Management believes that cash flow generated from operations will be sufficient to fund operations over the next 12 months and is considering debt restructuring options to manage its financial obligations. However, the company is also facing regulatory challenges, including litigation and investigations, which may have a material adverse impact on its results. Despite these risks, management remains committed to navigating these challenges while driving growth through strategic investments in e-commerce, digital transformation, and acquisitions. The company's resilience through various economic cycles suggests that it has a strong foundation for future success. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the most notable ones include the Brigit acquisition, which is mentioned in multiple pages throughout the document. The specifics of this acquisition can be found on page 55. Additionally, the company acquired Acima. On the other hand, there have been some divestitures as well. One such example is the sale of a Rente Center corporate store to a franchisee, which is detailed on page 80. This move suggests that the company is streamlining its operations and focusing on core business areas. The company's financial history reveals a consistent commitment to rewarding its shareholders through dividend payments and share buybacks. One notable aspect of the company's strategy is its regular payment of dividends, as evident from multiple instances documented in the provided summary. This demonstrates a clear intention to distribute profits among investors. In addition to dividend payments, the company has also engaged in share buybacks, further indicating a focus on returning value to shareholders. The fact that this practice is mentioned specifically highlights its significance within the company's financial operations. There are valid concerns about inventory buildup or supply chain disruption. The company's financial reports highlight several red flags. On pages 16 and 44, it mentions global supply chain disruptions, leading to reduced product availability and rising costs. This suggests that the company is struggling to maintain a stable supply of products. Furthermore, on page 50, there is an indication of potential inventory buildup due to higher inventory purchases amounting to approximately $165.4 million. Additionally, the increase in inventory levels from $28 million in 2023 to $911 million in 2025, page 76, raises concerns about overstocking. The borrowing base being tied to eligible installment sales accounts, inventory, and lease contracts, page 87, also indicates a significant amount of inventory. These factors collectively suggest that the company may be facing challenges related to inventory buildup or supply chain disruption. That concludes the financial summary for Upbound Group Inc. Feel free to comment below, and I will be happy to answer them when possible.